It's great to see you here. So certainly one of the big headlines this week has been the slew of earnings reports that we've gotten so far. Less than 10% of the S&P has reported. What's your assessment, your takeaway from the results that we've seen?
Well, as we know, Dave, the secret to happiness in life is low expectations, and the same is certainly true with earnings. We came into earnings season very low expectations, negative 6.3%, so companies can just step over that bar. We've had 10%, just over 10%, 53 of the 500 components report earnings, and they're beating. 83% of the companies have beat earnings estimates. On average, over 6%. So we were expecting negative 6%. We're getting plus 6% so far. We're also beating on revenues, plus 62% beat on revenues. Average beat was about 5% on the top line. So with the expectations so low, I think there's some upside here.
Did you address that to me because I've been setting the bar low my entire career?
It's my secret.
I caught that, right?
I caught that too. I didn't know if there was a backstory that I wasn't aware of.
I think so.
I think so.
Well, we joked about it last time I was on. We joked about that, and
it is the story of my entire career thus
just
far.
laying it out
Set
there
the
for
bar
everyone.
low, you can leap over it easily. But I've also noticed in some of these earnings calls, perhaps some analysts are suggesting that CEOs are sandbagging a bit in these calls, saying, well, we're starting to see some softer numbers come in right up at the end. Are you seeing sandbagging as well?
Well, that's the number one job of a CEO, right? Set expectations low, beat expectations. I think the market did it for the CEOs this quarter. They're being cautious into the second half, but I think we're going to see continued beats. And the thing is, everyone is really looking for more downturn in the market. We're seeing it in positioning. We're seeing it in everything else.
Why? Why is everyone looking for that downturn? Why is everyone asking about a recession? There's nothing indicating one.
Yeah, well, it's been the tightening cycle. It's been aggressive. People are saying, well, the lagged effect, et cetera, et cetera, et cetera. But, you still had that huge increase in money supply. You still had a 40% increase in money supply over. That takes a long time to work through the system. And if you look through to next year, and the market's going to start to discount, just like we discounted the bad news that we're seeing kind of this year, last year in the market down 27%, we're going to start to. We're moving up on halfway through the year here in the next couple of months. Market's going to start to look through 2024 earnings recovery, and that's why you're seeing some strength and some indecision. Even if we're nowhere near 248, which is estimates, even if we come down to 240, there's some upside here. And on a stock picker's basis, there's a lot to do.
So, Tom, the street is clearly, from your perspective, too bearish. If you shouldn't be positioned how it seems like traders have gone overweight bonds here, at least lately, and that was in the latest Bank of America Fund Manager survey, how should then investors be positioned for potentially that pop?
Well, look, now, the stock market never tops when people are overweight cash and bonds. The stock market tops when people are overweight stocks on margin and there are no marginal buyers left. You've got growth expectations at the lowest rate since the 2009 lows, March 2009. People are more pessimistic than when the economy was shut down in March of 2020 and we didn't know if we were getting a vaccine. And you're also seeing they're taking less risk than they've ever taken all the way back to 2009. And pessimism toward the real estate sector is worse at the levels of March of 2009. You can't give real estate away. Now, looking back with 2020 hindsight, would you have wanted to be a buyer of residential real estate where all the problems were in 2009? Yes. Is this the time to be residential real estate? I don't know. But I can say we are seeing some opportunity in these beat-down REITs and the beat-down REIT sector, which no one wants. You can't give them away, and that's what we do. We like to buy things that are in distress that have high quality.
And in that sector, you do have a pick, and it is VNO, Vornado. Tell us why.
Well, this one you literally can't give away. The problem is it's been packaged in with all of these B and C class. So if you think about the mall problem 2, 3, 4 years ago, everyone said all these B and C malls are going to go out of business. And guess what? They were absolutely right. But the A malls like Simon Property Group, they consolidated. They're busier than ever. They've got Lululemon. They've got Apple. Everyone's excited. I think the same is going to be true with commercial real estate. As the labor market loosens, more and more people are going back to the office. And when you look at Vornado, you've got the greatest buildings in the greatest city in the world. If demand for those fall in half, we have a lot more to worry about than commercial real estate. This is run by the best operator in the business, Steve Roth, obviously, and his proxies. But there's something to do here, and I just like to burden myself with the facts. So let's look at the facts. Since 2019, pre-pandemic, revenues are down about 5%. Funds from operation are down about 9%. The occupancy rate is down about 0.9% for the New York City properties. Like I said, Fifth Avenue, Madison Avenue, Park Avenue, Penn Station, the new developments, et cetera. But the stock is down 75%. And those divergences are where money's made.
But what about the leases, though, that are going to expire over the next year or two? That's a big concern there. What exactly happens to these buildings and some of the conversion that's already taken place with those empty office buildings?
Yeah, well, Steve Roth, look, if they didn't take him out on a stretcher during the great financial crisis, they're not going to take him out on a stretcher right now. They have been selling off buildings and raising cash over the last 24, 48 months. So they're in a good position to take advantage of the distress. But the demand, like you saw at the malls, for the highest quality properties, it's always going to be there from someone. And it's already priced in. We lost 16% book value per share since 2019. The stock is trading at a 40% discount to book if the entire thing was liquidated.
But the 10-city average on office occupancy, return to office, doesn't move, man. It is plateaued right at 49%.
Yeah.
It doesn't budge.
Yeah, because the labor, and by the way, that's in aggregate, okay, but at the highest quality buildings. So where Vornado's positioned, I think, no matter what, and as the labor market loosens, which we're starting to see because of all the tightening, people want to get face time, they want to go to work. You know, I've talked anecdotally to people that are laying people off, and candidly, the easiest ones are the ones that are working remotely, the ones that are in with the team and that are in the office. And as people get a little bit nervous about, you know, potentially losing their job as they see people getting laid off, they're going to want to be in the office. And I think you're going to see that collaboration, and you're going to see more and more people move back in. But to your point, we did lose a lot of malls during that mall cycle, but we didn't lose the best. And when we talk about Vornado, when we talk about Steve Roth, we're very, very interested.
We like your
By
conviction.
The way,
courageous call.
People are scared about cutting the dividend. They already cut the dividend 43%. So at this stage, you're still getting a 10% yield at these levels. There's room to cut more if they have to. I don't think they're going to because they recently cut in the last 75 days. I think there's opportunity for upside here. It's not for the faint of heart, little volatility, but
No
it's an
doubt.
opportunity.